Welcome to today's presentation where we have the pleasure to present the Inderes. To help us through today, we are joined by CEO Mikkel Rautanen. In today's event, we will take a closer look at your Q4 results and the full year results, and also, of course, your look into 24 through your guidance through the lens there. So that is the main topics for the event today. As always, you're very welcome to ask questions in the box down below during the presentation or in the end of it, but we will probably take most of them. And as for always, we need to full disclosure that we have a partnership together in Inderes and HC Andersen, and you own 20% in HC Andersen. But with that, I think I'll hand the call over to you, Michael.
Thank you, Michael. Welcome everyone on my behalf as well. Let's dive into 2023. So we released the numbers yesterday. Some highlights. Last year we started off pretty well. The first half of the year was fairly strong for us, driven by the success of our AGM product. But then going into the second half, we really started to feel the macroeconomic situation hitting us. So we saw clients pulling down orders, postponing their projects, and also going to the end of the year, especially in December, we saw a number of bigger event productions being either postponed or cancelled altogether. So in the second half of the year, this really hit our project revenue while the recurring revenue base get growing. Not an easy year from the environment perspective, but still we managed to pull off meeting the guidance we gave going into the year. So we met the guidance. We grew both organically and driven by the acquisition, and we improved our profitability compared with last year. Strategically, last year was the year we made some significant leaps in developing this company to the next phase. I would say last year was the year that our product portfolio really started to come together. We had the last pieces in our product portfolio entering the commercial phase. So being successfully out there in the use of our clients and generating revenue. So I would say now our product portfolio is stronger than ever, and it's also fit and ready for our international expansion. So also last year was a significant year where we really started our journey towards being an international company, and that big transformation is going ahead full speed. So that's last year in a nutshell. We'll dive deeper into the number details later on. If we look at the Inderes flywheel, how that's working, I want to highlight here that last year we also upgraded or updated the technology platform of our flywheel. So at the core of the Inderes flywheel is our technology platform on which our community consumes our content and interacts with each other and the listed companies and our analyst and community team members. This platform, the previous platform we had in use for 9 years, it really came to the end of life. So the last 2 years, our developer team has been basically from scratch building our new platform. And at the last quarter of last year, we migrated successfully the last services into this new platform. And now we are running our operations on a fresh technology platform that is continuously developing. It's developing really fast. And this is very significant for the scalability of our business model, especially given our ambition to build a Nordic flywheel. Number of listed companies over 400. In Finland, it's again almost all listed companies are our clients. and then the rest is mainly from Sweden in our events business. Significant growth, mainly driven by the acquisition we did at the end of 2022. Number of personnel after our IPO in 2021, we scaled up the organization significantly. We started an investment phase. Going into 2023, we didn't need to scale the organization anymore because we had done those bigger investments we needed to do, and now it's more of a seeking for organic revenue growth and improving profitability. So we don't see at the moment any significant need to scale up the organization. Number of community members, it turned to growth again in the second half of the year as the atmosphere among investors started to pick up again. One thing I want to mention in that number is that we're expecting it to decrease in the first half of 2024, and there's a technical reason behind that. Due to the migration to our new platform, it impacts the number how we report it, because it only counts for the registered users. But that's a technical thing. The overall traffic and activity level on the platform as such has remained stable. But I just want to flag that already in advance, so just don't get scared if that number sees a small drop next quarter.
And you talked about, of course, the number is something you can follow, but it's also the activity, how much is driven down there. And you also see that actually also rising together with, investors getting a little bit more appetite for investing again after a very, very difficult 22.
Yes, of course, internally we're measuring all kinds of community activity metrics we can think of. And the number that we report in our quarterly reports is just one KPI that we kind of like see as the most significant number to follow. But of course, there's a bunch of other significant KPIs to measure as well. No single number gives us the full truth.
No. But I guess it's not the number. It's that they are driving activity down there, right? That
exactly.
That's perfect.
Yeah. Going to the business units, equity research. The number of contracts grew by 6%. That's driven by us still winning a few contracts in Finland, though we are reaching so high market share that it's physically not possible to grow much in Finland without IPOs. But luckily, we have now defined that our home market is Nordics and Finland plus Sweden, so we have quite a bit of market to grow in, still ahead of us. This business area continues to grow and do strong profitability, but the profitability is impacted by especially our ramp up of the Sweden operations. So there we are in the process of building up the team, and it takes time before the contract base revenue starts to climb up. So we need to build this with a long-term mindset. But here the positive things is that we're seeing some pickup in demand in our sales activities. Probably it's because in the first half we were so focused on the integration after the acquisition. And in the second half we were able to focus more on our sales activities. But also we're seeing some positive signs in the market that really the listed companies are now getting to understand that you really need to start doing something in terms of investor relations to attract owners and get investors to be interested in your company.
So it is you who is picking up the sales effort, which is always nice. But it's also on the other side, the company thinking, I'm tired of my share price. It's not the right one. What can I do? Is that your sense or feeling that is also driving some of the pickup you're seeing right now?
Yes, because it's been a bit depressing market, especially for many small companies for a long time. And now the listed companies are kind of like, many are waking up that, yeah, actually we don't have liquidity, we don't investors are not that interested in us, and so on. Maybe we need to start doing something ourselves. We just can't wait for the investors to find us. And there, especially our concept and the approach towards retail investors, companies are starting to understand that retail is really important for this, and that way, that's one feedback we're getting from the sales in the market.
Perfect.
Going to our events business, so this grew significantly because of the acquisitions and had a good profitability. This business area has been in a bit turmoil since COVID came. So first it skyrocketed because everyone going completely online. And now during the last 1-2 years, clients have been going to hybrid, and we've had to adjust our offering to meet the new market, and I can say that we've done that successfully. We grew with the COVID, and we've been able to maintain those volumes and that level of revenue after COVID because of successful transformation to the hybrid world, not only in our event production capabilities, but also in our event platform through which this event, for example, is being streamed. So we have our developer team has done great work in developing our event platform to meet the modern requirements of hybrid events, and also building up the platform in a way that we can do these type of fully remote online events targeted for the investor relations and investor audiences in a very competitive way, so that we're not competing against the generalist event platforms. So that's something to be proud of. In this business area, if we go into the events, it's actually the biggest revenue line for Inderes right now. In Finland, we kept strengthening our position especially in the large cap sector, taking bigger and bigger responsibilities in the AGMs particularly. And then in Sweden, we acquired this operation at the end of 2022, and the year was very much focused on automating, on integration of that business. So transforming it into the concepts that we have in our events business, automating processes, introducing our new Stockholm studio, ramping up that capacity, and increasing the customer value of the productions. And once we have the concept on a really high quality level, our standards are really high, then we shift more into a sales driven growth. We have a very competitive and strong offering already as we speak, but our quality bar and our aim is very high. Investor relations software. This business area is gradually shifting from a product development phase into commercialization. It's the profitability is negative still, but as the revenue grows, it's starting to scale. And last year, the actually two important product components that we successfully rolled out to the market: the press release distribution system, very interesting market for us. We see that market is there's room for competition, and our clients are welcoming that competition and our modern alternative to the market, which actually quite nicely goes hand in hand with our wider investor relations offering packaged. And then the do-it-yourself solution for the interim report webcast. So now we can our clients can do their interim report webcast basically with a do-it-yourself solution, so that it's only one of our customer success managers who's making sure that everything goes smoothly. But it makes our event production capabilities way more scalable as we are rolling out this solution. AGM market, we really did last year a breakthrough in this market in Finland. So over 100 AGMs produced in the spring, and in the second half, we had very much interest towards our EGM solution. So we're seeing that many companies, they want to have their AGM with a traditional physical meeting or a hybrid meeting. We can offer both. They want to meet their shareholders face to face, and that's cool. But then when you go to EGMs, so extra general meeting, there the value prop of a remote meeting is very attractive, because you can do it so much more efficiently than the traditional AGM. From all perspective, and that's been attracting a lot of interest. We did the EGM of Finnair, very successful production, and the client loved it, and that's also gaining traction. And nowadays we've actually, because we are continuously investing and developing further the AGM product, we can nowadays offer a fully remote AGM production. So independent of where the organizer is and independent of where the participants is. So you don't need a production crew, you don't need a lot of production gear to do the AGM. You just need the organizer just needs the laptop to do the production.
Laptop and an internet connection.
Laptop and internet, and that is very significant for the scalability of these products as we go outside Finland.
So primarily, have you done AGMs and are now more going into EGMs? I guess that will also spread the revenue potentially more over the full year, instead of, AGMs are kind of a spring kind of.
AGM is the predictable part. That's the springtime, spring season, and then EGMs, they are always ad hoc. So that's not that predictable. But the product fit is perfect of the remote product there. And then we did the successful pilots for the AGMs in both Sweden and Denmark. Diving a bit deeper into the key figures and outlook, I'm gonna go through them very shortly, and please, Michael or audience, ask deeper questions if you want to dive deeper into some item. Revenue growth 27%. Sweden is now 21% of our total revenue. So reflecting our growth to become a more international company. Recurring revenue grew by 38%, now representing 61% of our total revenues, and project revenue by 13%. Profitability, so EBITDA is the number we're looking at, 10.6% compared with 9.4% last year, slight improvement there. And one thing I always like to remind about our number is that we are reporting according to the Finnish accounting standards, and This means that because of our acquisitions and our investment in you, HC Andersen Capital, we need to book goodwill amortizations in our P&L, and this is completely a non-cash flow item, but it's the total impact is around 1.3 million euros on the non-cash flow item on the P&L statement. Doesn't affect our ability to pay dividend or cash flow in any way, but that's something you need to take into account. If you look at our adjusted earnings per share number that we're reporting, that's a number that is cleaned from these accounting items. There are no other kind of like adjustments we make to the EPS number. It's just these accounting items. So it's not a number that we use to steer the attention away from what is relevant and significant. Looking at the fourth quarter, so the revenue growth slowed down to only 8%, and excluding acquisitions, revenue declined by 6%. And of course, we're not happy with that. It's mainly explained by the drop in our revenue in December, impacted by postponements and delay and cancellations of some event productions, and overall very weak project sales. That's a reflection of the economic situation, particularly in our biggest market, Finland. Still, profitability slightly better than in the previous year. Looking at our balance sheet, so the balance sheet continues to be strong, and we're net gearing is negative. One item to point out here is we paid out at the end of January 2.9 million payment, which was the second part of the payments of the acquisition of Streamfabriken and Financial Hearings. So that acquisition is now fully paid. That was reflected in the non-current liabilities, 3.6 million. So that came down by 2.9, paid out from our cash position in January 2024. Cash flow, we continue to generate strong cash flow. I mean, we like cash flow. We like to build a healthy, profitable business that generates strong cash flow. I think that's one thing that is in the DNA of this company, being founded by a group of analysts. So
equity analysts know what cash flow means. Yes.
yeah. And the cash balance is good. And here the one significant item post the end of last year is as I mentioned, the payment of the second part payment of the acquisition. So that's now fully paid.
So just to understand, your cash flow looks very similar to your earnings. So you don't activate any of your development costs and software and so on. That's one of the reasons, I guess. Normally you could see a big difference between earnings and cash flow. So is that correctly understood, that you immediately write off most of your development cost on the software side? Is that correct?
Exactly. We like to keep our balance sheet as clean as possible, and we're not activating any of our software development cost, even though that's a very, very big and significant item in our business model.
Business model,
yeah. Dividend. So the dividend proposal for this year's AGM is 85 cents compared with 82 cents last year, and we're proposing it to pay it in 2 installments. Why are we increasing our dividend? One reason is that we are living up to our payout policy, and why we have the ability to pay this level of dividend. Well, we have a strong balance sheet, we have strong cash flow, see that our profitability is improving, and looking ahead and looking at our strategy, we don't have any significant investment needs in front of us. So we can easily pay this dividend, and it doesn't affect our the implementation and execution of our strategy we laid out last spring.
I guess it's not the first time you have gotten this question. Normally as an equity analyst, when the dividends are running ahead of the earnings per share as a kind of a figure, you always ask, is it sustainable? But is that because you're actually more cash flow generative than your earnings generative in your business model? Is that one of the explanations, or what do you have any thoughts about the sustainability of running dividends ahead of earnings per share?
Of course, long term, it needs to go hand in hand with the cash flow. Yes. And as we see that we continue to grow organically, we continue to improve our profitability, and that should be reflected in improving cash flow as well. So that's how I see it.
Perfect.
Outlook for this year, where our guidance is that revenues will grow from the previous year, and EBITDA percentage improves from the last year, so from 10.6. Now, looking at this year, we need to be honest with the fact that it will continue to be a tough market for us. One significant reason for that is that during the past 2 years, there's been a lot of acquisitions among our customers. So our customers being acquired and taken away from the stock market. And many of these acquisition targets have been, unfortunately, some of our biggest clients. So we need to recover that revenue in order to even stay flat. However, given our growth investments we've done in the past 2-3 years, we've built up quite good growth bets, and we're seeing that those bets are starting to pay off. So that's why we believe that we will continue organically on a growth path.
There's actually a question from the outside. You are guiding margins to come up in 2024. What is primarily driving that? Is it top line that drive the margin improvement, or is it less investments? How do you see your guidance of improved EBITDA margins?
I would say it's mainly driven by top line growth. Yes.
Perfect.
Exactly. All right. Then to sum it up quickly on our strategy and the kind of like where we are on the big picture. So this is the evolution of Inderes. Even though we had a tough quarter, didn't grow much. I like to look at this picture and remind ourselves that yes, we continue to be a growth company on the big picture. So the story of Inderes in a nutshell, we started off with the commission research business. We built a platform and community around it. Then we diversified our product portfolio to add the investor relations events, AGMs, and IR software. We continue to grow because of this successful expansion. And now we see that this product portfolio is really coming together. It's competitive. The concept is really unique. So now it's a time to take it geographically, and now we are on the journey to take this company on a Nordic level. Sweden and Denmark being the important countries in the new strategy period. And to remind you, the audience, in Sweden, we did acquisition, and we're growing through that there. And in Denmark, we operate in collaboration with our strategic partner and investment, HC Andersen Capital. This is the product portfolio we have. Each and every one of these individual products is competitive standalone in its own market. But as we combine this product portfolio together and we bundle it and we create synergies between them, we integrate them to the Inderes platform, through which the listed company investor relations can reach the relevant target groups, the audience that they need to reach. That is what really makes the offering unique and competitive in the market. Financial objectives. So our ambition and long-term target is to reach annually growth rate and profitability combination of 30 to 50%. I see that this company has potential, like we've demonstrated in history, potential to reach significantly higher margins than where we are today. That margin improvement long-term will require ramp up and scale up of the software business. That is a really significant driver. Like I've said, we've been in a product development phase in that business area and now shifting towards commercial scaling. So that will be a significant driver. The other one is equity research. So equity research in Sweden particularly. So equity research is a high margin product for us. In Sweden, we are in a ramp-up phase, which significantly impacts our profitability in the short run, and scale up of that business is also a significant profitability driver. So the current margin, I see it's a mix of current market conditions, the development phase of our certain product areas. And also our biggest revenue item right now is events business, and in events business, the margins in that industry by nature are lower than for example in software, of course.
There is a question here, and I don't know whether you want to answer that because that might narrow in your guidance, but I have to ask it. 24, will that be in the target range for your long-term goals? Will 24 also be in the range 30 to 50% down on, in the black line in total? Yeah. I don't know whether you want to answer that because it will narrow your guidance, but I have to ask it, Michael.
Yeah. Like you said, it's difficult to answer because I don't want to take the risk of getting a phone call from the financial authorities after this presentation. So
I will let you off the hook.
Let's lay it out this way. Guidance is the guidance for this year, and this is our long-term financial target level where we long-term aim to land year after year as a company.
Then let me ask in another way and look a little bit longer term. If we can go back to the slide. You had 2 years with you had 2 years with 20% in margins. I know they were a little bit special years. One of them were a Corona year with a lot of project revenue and so on. But in your mind, with your current business model and your targets and such, is your current business model also able to make those margins in the long run? I'm not asking you to guide what is coming next year or next year again, but is that is that a potential target range? Is something changed in your business model since those years, or were they extraordinary years, or is it also something you look at and saying, we made 20%, our business model is even more scalable now with software and so on, compared to that time? So is 20% achievable, also in the future?
Yes, it is.
Clearly answered, so I don't need to more. Perfect.
2020, 2021, they were very strong year for the event business because of COVID, and then also for other businesses because of the IPO boom. So we did have quite a bit of tailwind from the market that we need to acknowledge, but we've been continuously building up the scalability of this business model, and long term it will be also more software based and more scalable deliveries. So yes, absolutely. I'd say in the target range 30-50, it's built in that we need to build strong profitability business in the long run.
I guess it's hard to achieve 30% growth every year only on the top line. And nearing 50. Yeah, perfect. Makes sense. Yeah, but you gave a very short answer to me asking a very long question, so it can't be better.
But yeah, that's for me to conclude. Like it's always good to also remind that it's a great day to start investing in stocks. Everyone, do we have any further questions?
Yeah, there is. In which areas will you focus your investments in 24? It seems like you can scale a little bit down on the software development side. I think I saw that the part of as part of your revenue it's falling a little bit. I know it's because of acquisition. So in which part will you actually make your investments? Because I think in your guidance you also indicated that you will continue to invest also this year.
We're not, by the way, we're not scaling down our software investments like
no, but as a part of a revenue.
This year, strong focus areas, the investor relations software business and Sweden operations, both the events business and equity research business in Sweden. Those are the most important.
And with investments coming down as a part of revenue, will IR software be profitable this year? I don't know whether you feel comfortable to guide. I think it hasn't been profitable as one of your businesses, but will the corner turn here in 24, or is it still too soon to look for profitability in that special area?
We're not giving out the detailed numbers for that, so I can't. It's very difficult to guide one business unit on 1 year level. I can only say that the ambition is that we're shifting towards scaling phase in this product area. And overall in Inderes, I mean, we have built a fantastic product portfolio we can be proud of, and now it's more about scaling that, selling that product portfolio, taking out to the market. So very much also a significant investment area for us this year is to build up our outbound sales capabilities, sales processes. I can be honest that Inderes from history, we have been selling point solutions. We have been one unit selling research, one selling events, one selling software, and the fourth one selling AGMs. And we need to change our way of thinking from selling these point solutions into selling investor relations products and investor relations solutions. It requires changing our way of thinking. It requires changing our way of selling, the sales processes, the sales system, and so on. So that's a big transformation for us as a company. But we're already seeing that the concept of selling these in a easily bundled package that is easy to buy for the listed company, with all the benefits and efficiency that the IR gets from it. It's a very, very competitive offering, especially for the small and mid cap sector companies who don't have the resources internally for the IR.
And last question, you mentioned international span. Could that be outside the Nordics? I know Denmark, Sweden, but could it be outside Nordics? Could it be, if the opportunity arises, there's a partner interested in your software and so on? Would you be willing to also look outside the Nordic regions in this phase, or are you 100% focused here?
Of course, if an opportunity arises, we look into it. But otherwise, we are not actively looking outside Nordics. So from that perspective, we are very, very focused on the selected product areas and the selected markets. But of course, we keep our eyes open for opportunities if they happen to arise.
And your field, and I can also give my field, but it's a little bit stupid. We are in the same world. The package you actually develop, that would actually fit outside the Nordics, right? If you look out in the world, this is not that different how organizations do it. I know there would be twitches, I guess, to which system you integrate to, but it should kind of be able to go outside also the Nordics. We are not. Is that also your feeling that we are not a special region with special rules or special ways to do IR and do this stuff? So just to get your feeling of that.
Yeah, I mean the basic dynamics of investor relations is the fundamentals are the same no matter what country you go to. At the end of the day, this is about connecting the company and the owners and the investors, and going deeper. It's interaction between people at the end of the day, and that's at the core of Inderes. Yes, the product portfolio requires, I think, local presence, being close to the company, being close to the investor. That's important in our business model. The products require some localization for new markets, but kind of like once we've done this in Denmark, in Sweden, probably we're gonna be quite more educated on how this concept can be rolled out to the third and fourth country, and so on. So we are now in the process of learning the go-to-market of Inderes flywheel to new countries, and I'm sure that once we have done this in a couple of countries, we have way better capabilities to take on the next countries. But the good thing is that, I mean, Sweden and Denmark only, or the Nordics, there's quite a lot of work for us to do still for the upcoming years.
Perfect. That was all, Michael. Thank you for taking us through your last year results and looking a little bit ahead, and thank you for the audience for listening in. May everybody have a nice day.
Thank you, Michael. Thank you, audience.